We are looking to get a brief update on healthcare. Can you lay the backdrop for what you are seeing?
There's a lot going on this year, and I think there's first a couple things we need to address. And the first one is that the long-term thesis for this sector, the permanent and non-cyclical drivers of aging populations, developing nations, and technological innovation have not changed in the short term, and that really forms the positive outlook from our perspective over the medium to longer term. Second is over the past couple of years where healthcare has outperformed in the down market in 2022, it has generally lagged since then as tech plus and high growth consumer has really been driving the broader markets. In the very short term, from a macro perspective, the fact that the US economy has shifted from all but certain rate cuts with relatively sticky inflation has caused expectations for interest rates to stay relatively high, and with cuts uncertain in the short term, that has caused some volatility, in particular as we've moved into the spring months. So when I think about healthcare, it is not immune to some of those macroeconomic drivers, and really important, I think, for us to peel back the layer and look at some of the shorter term drivers specific for the sector.
Given the volatility we have seen since March, how has that impacted healthcare? What has been working and what hasn't?
Well, as I mentioned, healthcare hasn't been immune to the broader market sell-off. However, it has performed relatively well. I think when we look across the market within the subsectors, there's been very wide bifurcation, or as we might say, differences even within the subsectors in the broader healthcare sector. And so that's exactly what we see within healthcare, big differences in subsectors that are working and those that aren't. When we look at areas within the sector that aren't working, such as managed care, these are companies that provide insurance and administer health care plans for individuals and for government programs. That group's down mid-double digits compared to the tools and diagnostics sector, companies that make lab equipment and biological drug equipment, for example. That subsector is up double digits. Now, the difference for this is broad and ranges from within managed care to Medicare Advantage, having some challenges through to some improvements in the destocking cycle for tools and diagnostics. It does advocate diversity across subsectors, and importantly, when we look at even in those subsectors, we've seen a very wide divergence in individual stock performance as well.
You have talked about company earnings in the past. What is your current takeaway?
So we're about halfway through the earnings season thus far, and from what we've seen, positive results are being rewarded with strong stock performance. And for many of our companies, that's exactly what we've seen. And the results have actually been not just stronger than expected. That's especially true in our tools and diagnostics that we've talked about earlier, but also within medical devices. And so that's really driven on the back of better healthcare utilization that we're seeing in the United States. I would say the biggest divergence that we've seen has been in the pharmaceuticals, where the science is really dictating what's working. And we see this with competing companies like Bristol Myers and Merck, where the latter is really outperforming. So look, again, for most of our companies that were reported, we really like the visibility that we're seeing, and in particular, the guidance that we're hearing from management teams for the balance of this year.
What are the biggest drivers for innovation?
So the GLP-1 class we've talked about a lot. That's continued to show very promising results and really expanding from diabetes and weight loss. Recent phase 3 trials for sleep apnea really just validate that this is going to be a very large class of drugs. They're also testing various types of combinations, and it's really exciting. So it's, from our perspective, a $3 billion market in 2021 with fairly easy growth, we think, to a $100 billion market by the end of the decade, and that's massive. Now, we do have to be cognizant of valuations, not be overexposed to the area, but we very much think the GLP-1 drugs are very, very strong and delivering positive results. The other area on the device side, recent results from some of our companies really validate the view that we have on robotic-assisted surgery markets, that they're growing at very, very strong rates.
Can you talk about valuations within the healthcare subsectors?
So first, I would highlight when we look back over history, healthcare is known as a superior good. Generally, we need these services and devices in up and down markets. And what that does for us from an investment perspective and an earnings perspective, it means we do have some relative visibility into the corporate earnings. And so we see that also we have less variability of the growth across economic cycles compared to the broader market. So that's quite positive. So we do have some visibility into the corporate earnings. From a specific valuation perspective, we see very attractive valuations on forward earnings expectations and forward earnings multiples, meaning attractively valued from a price to earnings perspective, both in absolute terms, but also at quite a discount to where the broader market is trading. When we look at growth, however, and look out the next 12 months, our expectations would be to see growth amongst the top 3 performing subsectors from an earnings growth perspective. So when we put that all together, we see very attractive valuations, visibility, and solid earnings growth.
How has HHL been performing, and what have you been doing in this environment?
HHL is the Harvest Healthcare Leaders Income ETF, and it has 20 large capitalization healthcare stocks. So we actively select those holdings on a quarterly basis, and we use a covered call strategy to generate cash flows on a monthly basis. So we aren't immune to the broader market, macro environment, and the recent pullback. However, I would say in this environment, HHL is one of the best performing healthcare ETFs in Canada over the past 1, 2, 3, and 5 years. So the ETF has about 1.5 billion, and we're now in our 10th year of its life. We've paid the same monthly distribution of 5.83 cents every month since the start of the fund. So we did make some changes to the portfolio last year. That's had actually a positive impact. We've sold out of some of our pharmaceuticals and added the tools and diagnostics. And more recently in April, we did a deep dive of our current holdings and our subsector allocations. And we're very pleased with how we're positioned from a diversity standpoint and from a style standpoint. So I would say in the very short term, we've been much more active on our covered call strategies. As volatility has picked up, this really increases the opportunities for us within the option strategy to allow us to generate the cash flow on a monthly basis, but to do it in a tactical and smart manner.